In the second video from Chapter 8, we are going to look at the computations necessary to compute consolidated taxable income. To compute consolidated taxable income, follow these basic steps. First, compute separate taxable income for each member of the group, the parent and all of the subs. Then remove something we're going to call group items from the calculation. Also remove intercompany items. We'll define both of those in greater detail in just a bit. And then adjust the intercompany items as needed, and maybe or maybe not recombine the adjusted intercompany items with separate incomes. For the group items, compute group item limits based on our consolidated income and recombine the group items with the separate incomes, and that will give you your consolidated taxable income. First, let's look at group items. What do you mean by group items? Group items, well, here's one, net operating losses. A net operating loss is a group item because it is deductible only up to combined taxable income. So if you've got one corporation in the group with a net operating loss, pull that loss out, then calculate combined taxable income for the entire group, and then see how much of that loss you can actually deduct. So you've got to get the consolidated income before you know how much of a net operating loss is deductible. Section 1231 gains and losses, we have to pull those out. A net loss is a deductible loss, and a net gain is a capital gain. That is, unless the 5-year look-back rule applies. So we need to look at our 1231 gains and losses to determine whether we have a net gain or a net loss, but we won't know exactly what to do with it until we see all of the 1231 gains and losses. Then we'll know whether we have an overall net loss or an overall net gain, which will be treated as a capital gain. Capital gains and losses, and that would include the net 1231 gains if we have it that we just calculated. Capital losses are deductible only up to consolidated capital gains, so you need to look at all the capital losses and gains before you figure out exactly what to do with them. Continuing on with group items, interest expense. Interest expense deduction may be reduced if consolidated gross revenue exceeds 30 million. So you don't know how much interest expense you can deduct until you can see consolidated gross revenue. Similarly, charitable contributions, the deduction is limited based on consolidated taxable income, 10% of consolidated taxable income. So you need to know the consolidated number before you know how much charitable contributions can be deducted. Dividend received deduction. Well, the 100% dividend received deduction is not restricted by income. You can get the 100% dividend received deduction if you qualify for it. But the 50 and 65% dividend received deductions are, or could at least be limited based on consolidated taxable income. So you need to know what your consolidated taxable income is before you know how much dividend received deduction is available. Intercompany items, as the name implies, involves transactions among companies in the consolidated group. So the sub sells to the parent, parent sells to the sub A sells to sub B. Those sorts of things are all intercompany items. Permanent eliminations will happen if there's something that just needs to be permanently removed among the members of the group. For example, gain recognized on a property dividend. We'll talk about dividends in just a minute, but a gain recognized on a property dividend is recognized by the payer of the dividend. If you use property and the fair market value of that property is greater than the basis of the property, the dividend payer must recognize a gain. That's a rule that we've seen in standalone corporations. But if it's a dividend paid from one group member to another, then that gain should not be recognized. It will be eliminated as an item. It will be pulled out from the calculation of consolidated taxable income. Dividend distributions from one group member to another, as we saw in the first video, are always permanently eliminated. We'll talk a little bit more about that in just a bit. Other intercompany events, such as intercompany sales, provision of services, loans, etc., may require temporary adjustments. So, for example, if the parent provides a service to the sub and gets paid for it by the sub, that would be revenue to the parent, and it would be a deduction for the subsidiary. Well, if they're both on the same accounting method, they're both on the accrual method, both on the cash method, it won't matter. It'll be a wash. But if one's on the cash method and the other's on the accrual method, the timing may be off. So pull those out, and then you can put them back as necessary when the timing catches up, so everybody is on the same page. Why do we eliminate dividends within the group? You may be thinking, dividend from a corporation that's owned 80% or more, you get 100% dividend received deduction. What's the difference between a dividend that gives you 100% dividend received deduction, not subject to any level of income of the consolidated group? What's the difference between that and simply eliminating the dividend? Well, consider this group. This is a group from our first video. Remember, P owned 80% of S and P, and then S owned 30%, T owned 50% of Z. So Z is a member because 80% of Z is owned by other members in the consolidated group, and P is the common parent. If Z pays a $1 million dividend, it will pay $300,000 to S and $500,000 to T. Unconsolidated corporations would get a 65% deduction. So on S&T's unconsolidated calculation of taxable income, there would be a 65% dividend received deduction, and there would be a 35% of the dividends actually included in gross income. So we're eliminating as an intercompany item the dividend from Z to S and to T, because we can't just rely on the 100% dividend received deduction to take care of the problem. It wouldn't in this case. Here is an example of a worksheet that we're going to use. It's based on Exhibit 8.3. It's not exactly the same as 8.3. I made it as close as I could and still fit it into the screen. So check page 817 of the textbook, and you'll see Exhibit 8.3 with a form that looks very much like this, even though it's not quite perfect. And when we start filling it in, you'll see that the examples that they give in the textbook of how to fill it in, we'll run out of room very quickly if we don't make adjustments for that. You'll see that when we work through one of our problems. But we're going to use this basic form throughout. But first, let's do problem 838. This is very simple. What they want to do in problem 838 is compute consolidated taxable income for various years. We've got Blue Group, which elected consolidated status immediately upon creation of its two-member corporations in January of year one. So that's Blue Group, consisting of Blue Corporation and Orange Corporation. All recognized income is earned through the consulting services of the firms. There are no intercompany transactions in the indicated years. All right, so let's see what we've got. In year one, Blue Corporation has a profit of $250,000. Used to that number, you'll see it again. Orange Corporation's a little more variable. They had in year one a $70,000 loss. Consolidated, $180,000. Well, that's just $250 minus $70. So there you go. Because there's no intercompany transactions and apparently also no group items that we need to worry about. If you have no intercompany items and no group items, then just sum the two corporations, and that's your consolidated net income. Year two, Blue holding at $250. Orange, also a loss year. 30,000, and so the consolidated is, what do you know, 220, 250 minus 30. Year 3, still at 250. Orange, big loss year of 240, so consolidated taxable income is 10,000. And then in year 4, another 250 for blue group. Orange finally started making some money, 85,000. Our consolidated taxable income is 335,000. As I said, that's almost too simple. All we did was take the two numbers and add them together. Presumably, if you are in graduate school studying accounting, you know how to add and subtract. So that's essentially what we're testing in problem 38. Can you add and subtract numbers, one of which is 250,000? Okay. It gets more complex. We will see a much better problem in just a little bit. And here it comes. Problem number 44. PS is a consolidated corporate group. P company is the parent corporation of S company. And we are given results below pertaining to their separate company information. And so what we want to do is compute consolidated taxable income. It says first compute the separate company incomes of P company and S company, considering all of the individual elements of their income. And then use the framework from Exhibit 8.3, pull out the group items and the intercompany items, then apply those adjustments to the separate income, and then analyze the intercompany items, then analyze the group items and the basis of your total consolidated taxable income to date, and that will give you your overall consolidated taxable income. So here we go. This is our worksheet. Looks just like the one I just showed you a moment ago, except that we put PICO and ESCO in there for the parent and the sub. Ordinary income and loss, we can read that right off of the problem. For PICO, it's $100,000 ordinary income and loss. ESCO is $40,000. There's some Section 1231 gains and losses, a $10,000 loss for P and an $18,000 gain for S. Capital gains and losses, we have a $5,000 gain for P and a $3,000 loss for S. That will be deductible for S because on a separate return, S has 1231 gains. Assuming the look-back rule doesn't apply, those will be treated as capital gains, and you can deduct a capital loss against the gains. We also have a gain from intercompany sales, $17,000 from sales that P made to S. S has no intercompany transactions that it's recognizing. So at this point, take a subtotal, and you've got $112,000 for P, $55,000 for S. So 100 minus 10 plus 22 is 112. 40 plus 18 is 58, minus 3 is 55. Then we had charitable deductions. The deductibility of the charitable contributions will be based on taxable income before the charitable contribution. P company has $13,000 of charitable contributions, but can only deduct $11,200. So therefore, P company's total taxable income is $100,800. S company has $2,000 of charitable contributions. The limit would have been $5,500. They didn't hit the limit, so they can deduct all $2,000. Their taxable income is $53,000. So there's the starting point. Separate taxable incomes of P and S, $100,800 and $53,000. So let's go to our worksheet. $100,800 for P company, $53,800 for S company. Now we're going to be doing the adjustments. Our adjustments will be, well, first of all, we have to take out the gains and add back the losses for Section 1231 transactions. So P company had a $10,000 loss, we'll add that back, and S company had an $18,000 gain, we will subtract that out. For the capital gains, again, subtract the gains, add the losses. P Company had a $5,000 gain, so subtract that. And S Company had a $3,000 loss, add that back. We also had one intercompany item, the $17,000 profit that P Company made from the sale to S. Subtract that out as an intercompany item. S had no intercompany items on its books. And then the charitable deduction, take those out. The amount deducted, $11,200, so add that back. And for S Company, add back the $2,000. Notice that P Company has $21,200 of positive, $22,000 of negative for a net negative $800. And S Company has $18,000 subtraction and $5,000 of additions for a net subtraction of $13,000. So let's put those into the worksheet. Adjustments of negative $800 for P Company and $13,000 negative for S Company. So we have $100,000 even as the post-adjustment amount for P and $40,000 as the post-adjustment amount for S. Next, let's look at our intercompany event, or in this case, event. There was just one. The intercompany inventory sale with a $17,000 profit, but we are not going to add that $17,000 profit back until something happens with the sub who bought that property and they do something with it. So for now, no adjustment for intercompany events. Pulling the $17,000 out was correct, and we'll leave that alone. So nothing there for intercompany events. So just put a 0 in the intercompany events, and of course a 0 in the post-adjustment amounts. Then finally we can do our group items. Now the adjustments that we made, section 1231 gains and losses, capital gains and losses, skip the intercompany sale, we took care of that, and then the charitable deductions, we will have to look at those. So those are the adjustments. First, the section 1231 gain or loss. It's a net gain of $8,000. So that's fine. We can leave that in. It was $18,000 of gain and a $10,000 loss. Similarly, with the capital gains and losses, that was also a net gain, $5,000 gain versus a $3,000 loss for a net gain of $2,000. So those are fine. We can just take those items and put them back into consolidated net income. There's nothing in intercompany income that would change the fact that we're adding a total of $10,000 here. For charitable deductions, however, there we have to check out what's going on. We have a total of $15,000 of charitable deductions, 13 by the parent and 2 by the sub. But we do have to check out our consolidated limit. So that's the asterisk here. What is our charitable deduction limit computed at the consolidation level? Well, it's going to be 10% of consolidated taxable income. Well, what's consolidated taxable income at this point? Well, our separate taxable income, $10,800 plus $53,000. So bring those in. Then we had the adjustment, negative $800 for the parent, negative $13,000 for the sub. So bring those in. And then finally, we have the section 1231 gain of $8,000 and the capital gain of $2,000. So bring those in. So 10,800 plus 53, $153,800 minus 800, $153,000 even, minus 13,000 is 140, plus 10 is 150. So 10% of 150,000 is exactly 15,000. So the total amount of charitable contribution was 15,000, and the charitable deduction limit is also, by coincidence, $15,000. So if this consolidated group had contributed one more dollar, it would have been a carryover. They wouldn't have been able to deduct it. 15,000 was the limit. As it is, they can deduct all 15,000 of their charitable contributions because they just happened to hit exactly the charitable deduction limit. So we have $10,000 of increases in our group items, 15,000 of deductions for a net of $5,000. Go back to the worksheet, put the $5,000 in as an adjustment, and over in the post-adjustment amounts, now we have our consolidated net income. 100 plus 40 minus 5 is 135. That is our consolidated taxable income. And that is how you use Exhibit 8.3 worksheet to calculate consolidated taxable income from the two separate corporations. So that's problem 44. That is a very good problem, I think, for illustrating exactly how you're going to proceed to calculate consolidated taxable income. Net operating losses. Net operating losses are interesting because what do you do if you've got a net operating loss and membership changes? There's an example in the book. If a member corporation leaves the consolidated group and that group has a net operating loss carryover, well, then when the member corporation leaves, does it take any net operating loss with it? And if so, how much? So they give an example in the book of a parent with a profit of $100,000. The first sub has a $60,000 net operating loss. The second sub has a $120,000 net operating loss. And let's assume no adjustments of any kind. So we wind up with a group net operating loss of $80,000. Then sub 2 leaves the group. Parent sells all of its sub 2 stock to an entrepreneur of some sort. So now sub 2 is no longer a subsidiary. How much, if any, of that NOL does sub 2 take with it, and how much remains with the consolidated group? Well, they gave us a formula in the book. Formula is on page 824, and it says the members' separate NOL divided by the members' aggregate NOLs times the consolidated NOL is the members' apportioned NOL. Now, I stared at that formula for quite a while before I realized the importance of punctuation. The numerator of that fraction is member apostrophe S, the single member whose NOL you're trying to figure out. The denominator there is members S apostrophe. It's the aggregate NOLs of all the members. So it's the placement of that apostrophe that is driving that whole fraction there. So in this case, the member that we're concerned about is sub 2 with $120,000 NOL. We're going to divide that by the aggregate NOLs. Sub 1 had a $60,000 NOL, sub 2 with their $120,000. So that's a total of $180,000. Multiply that by the consolidated net operating loss of $80,000, and so you get 2/3 of $80,000, which doesn't come out even, but it is $53,333. That is how much sub 2 will take with it to its new non-consolidated existence. Now let's take a look at problem 40. Notice I skipped this one because this is more about the NOL sharing, and so we went from 38 to 44. Now we're back to 40. Cougar, Jaguar, and Ocelot corporations have filed on a consolidated calendar year basis for many years. At the beginning of the tax year, the group elects to deconsolidate. Now, it makes it sound like you just do that. You do need IRS permission, but presumably they got IRS permission. Okay. They have a $6 million NOL carry forward that can be traced 1/2 to Cougar, 1/4 each to Jaguar and Ocelot. Well, they kind of gave away the answer when they posed the question this way. The question is, how will Ocelot treat the NOL on its separate tax return? Ocelot can use NOL of, well, it's $6 million in total. They said 25% applies to Ocelot. What do you know? That's $1.5 million. Okay. So if you can figure out what 25% of 6 is, you can answer this problem. All right. Then they say letter B, express the computation as a formula using Microsoft Excel. We don't need to do that. I trust that you can multiply by 25% in Excel. or in PowerPoint, as I just did, or on a calculator or in your head. Some of these homework problems are more challenging than others. I really like 44, not that crazy about 38 and 40. Separate return limitation year. This also has to do with net operating losses, but now it's working from the other end. Instead of how much net operating loss do you take with you when you leave a group, this is about a loss that you bring with you when you join a consolidated group. Corporation that enters a consolidated group with a net operating loss carryover, the rule is you cannot use that loss carryover to offset consolidated income contributed by other corporations in the group. So what can you do? The limit to the amount of the separate return year loss that can be used in a consolidation year is the lesser of sub's separate income for that year or the sub's cumulative contribution to consolidated income up to that year. That's a bit complicated, but there's a nice example that they give in the book, so we will go through that example in just a bit. One thing you need to know is that limit does not apply to the parent corporation. So the parent is not subject to this, but a subsidiary coming in with a net operating loss will be subject to this limit. And also, don't forget the Section 382 limits that we learned about in Chapter 7. They still apply. As a matter of fact, you apply them first. Then see about this separate return limitation year, SRLY. I look at that, I always think of SALY, which stands for same as last year. We don't like to say that one out loud. It's our little shame. But we frequently, sometimes it's very useful. What did we do last year? That gives us a very good guide as to what we should do this year. I will say that knowing what was done last year is very handy. Following what was done last year blindly without looking at it critically, not a good idea. And when people say Sally did it, they're saying that we blindly followed last year without critically thinking. Okay, anyway, that's not what this is. This is something completely different. So, separation return limit year. Here's the example. In year one, that was a separate year. The parent had $100,000 of income. The sub had a $40,000 net operating loss. That is simply the sub's net operating loss. There was no consolidated return that year. In year two, we consolidated $100,000 of income for the parent, a $10,000 loss for the sub, so the consolidated return can't use any of the $40,000 in that year because we're limited to sub income, and there is no income. It's just a loss. So consolidated is $90,000. Year three, $100,000, and the sub has $15,000 of income. So now we've got $115,000 of income minus whatever we can use of the subsidiary's separate year net operating loss. So the year three limit is going to be the lesser of the $15,000 income earned in year three, the cumulative income since the consolidation, which is 15 minus 10, or 5. So the lesser of 15 or 5 is 5. So subtract out 5,000, so it goes from 115 down to 110. Then in year four, parent had another $100,000 of income, and the sub had $70,000 of income. So our year four NOL limit is the lesser of 70,000 or 75,000, which of course is 70. The 75,000 is the 70,000 plus the 15 and then subtracting out the 10, the cumulative income. That gives us 70,000, which is our number, but of course the only NOL left is what's left of that 40,000. We used 5 in year three, so we've got another 35 that we can subtract in year four. And so we're at 135. 100,000 plus 70,000 minus 35 is 135. Stock basis of the subsidiary. This is actually covered in the book earlier. I moved it to the end because I think it fits better after you've seen how consolidated net income and some of this other stuff is computed. Parent's basis in the subsidiary stock begins with what the parent corporation paid for it, like the basis of all assets. Start with original cost. Then adjust it. We're going to have to adjust each year for the subsidiary's share of consolidated income. That would be added. Or the subsidiary's share of consolidated taxable loss. That would be subtracted. So you're going to reduce basis by the amount of that taxable loss. We will also subtract the subsidiary's dividends paid to the parent. That will be subtracted from basis. Think about what you would do if you are using the equity method for financial accounting purposes to account for the ownership of the sub. You add the subsidiary's income or subtract the subsidiary's loss, and then subtract dividends received from the subsidiary. Same sort of thing is going on here for tax purposes. One thing is different about taxes is that basis can never be negative. If basis falls to 0 and the subsidiary has additional losses, Congress decided to fudge things a little bit. They said, okay, basis can never be negative. We don't want to change that rule, so fine, basis cannot be negative. We'll create something called an excess loss account. And if the parent sells the subsidiary's stock, it will increase its recognized gain by the amount of that excess loss account. So we couldn't reduce the subsidiary's basis to negative $20,000. So instead, we will create an excess loss account of $20,000. And then if the basis falls to 0, and then we sell the subsidiary for $100,000, we will have $100,000 gain, $100,000 of proceeds minus 0 basis, plus a $20,000 excess loss account for a total gain of $120,000. It's very much the same as if you allowed basis to become negative, but basis can never be negative, so we use the excess loss account instead. If you think of it as negative basis, you wouldn't be wrong. That would be pretty much a good way to think of it. That is it for Chapter 8, Consolidated Returns. So we are now done. We will move on to partnerships in Chapter 9 next.